start with you, Jessica. Your company caters to a lot of institutional investors, big institutional investors, some of the biggest in the world. Are they demanding better measurement of impact? Are they demanding any information on impact and sustainability? And if they are demanding more, what sort of things are they looking for?
Sure. So we actually, just as background, for those who don't know Cambridge, we have over 1,000 clients. We had originally, when the firm was founded, been working primarily with endowments and foundations. That's since expanded to actually about a third of our business is focused on working with high net worth individuals, and we work with pensions as well and have a growing practice there. And the MRI practice that Matthew referred to that I lead was formed about 9 years ago, going on 10 years ago, really in response to hearing a lot of demand from foundations primarily at first, and then as soon as we kind of had set up shop, it was a lot more types of our clients were interested in exploring mission-related investing, as we describe it, but of course encompassing ESG and impact investing and social investing of all flavors. And I will say that over time, the number of clients having interest has grown substantially. And we even just surveyed our clients within the past few months on their activities around mission-related investing. And we just specifically surveyed our nonprofit clients in this case, and about a third of them responded that they were doing some sort of mission investing. And I could go into plenty more of the details that came out of that survey, but relevant to this panel, we asked the question, among the many things we asked, which was about how clients are thinking about impact measurement. I mean, we have done, for decades, work around performance measurement, and specific to impact investing, had partnered with the GIN 2 years ago to do a study on the performance of impact investing funds. But even just within that report, there were questions about why we didn't include more on impact. And so we surveyed our clients, and I mean, the short answer is, not that many have still asked for very concrete social investment performance. We still find that a lot of our clients are looking at the financial performance of their impact investments, and wanting them to succeed in that way. And this was the first time we conducted the study, so I don't have historical data to point to. But I would just say anecdotally, we have seen more clients that have asked. We have had for years just focused on the impact side of impact investing as part of our due diligence. And I think that's really no longer sufficing for a lot of our clients.
What do you mean by that?
I just mean that we conduct rigorous due diligence when we're looking at a fund. And if it's an impact investing fund, we take a specific look at the impact that is intended by the fund manager. What are they hoping to achieve? What sector are they playing in? And we make an assessment of whether or not we think that that fund manager can deliver on its impact. And that's just an ingoing due diligence question. But I think what we're starting to hear that the survey revealed and what we've seen from clients is that there's just really more interest in understanding the impact on an ongoing basis, not just going in, but really what the outputs are. And I know this, I will just, so yes, there's more interest. And I will just say, while this is a measurement panel, and we will kind of continue to use those words, really what we're doing is more of a assessment and reporting. And so we're, as a consultancy, looking at fund managers primarily, not looking at company level data. That's not our role. We're looking at fund managers and what they're doing. So our role, we feel like, is pushing managers to do better themselves on reporting and assess their approaches. So we're holding really fund managers accountable to their impact goals. So broadly, that's what clients are asking for, and that's what we're delivering for clients.
And what do you see as the key challenges in trying to measure impact?
I mean, the key challenge is just trying to put on any type of overarching structure on a million different things that look different. I mean, there's really no way to look at public funds the same way you'd assess the impact of private funds. I mean, off the bat, you've already got two very kind of different approaches right there. And then within private managers, how do you look at somebody focused on education technology the same way you look at somebody who's trying to create jobs? So there's all just sorts of different metrics, different criteria. And so, I mean, I can get into a little bit more of the weeds of our approach, but it's really about upfront an assessment of what managers, fund managers, are trying to achieve, and working with them to determine what metrics are the most applicable to them. And then as part of our ongoing due diligence, we'll hold them accountable to those.
So Jessica, if you're doing all of that, why are you not reporting back to the client?
Oh, no, we are. I mean, I'm saying that we're not necessarily, what we're not doing is saying this fund manager is inherently more impactful than this fund manager. But we are reporting back to clients on what their activities are.
So you're not rank ordering.
Allowed to interview other panelists? Is that part of
I thought this was a conversation between experienced professionals.
Matthew, let me
Leave it to
let me interrupt your
gate.
conversation, Matthew. With
Sorry, it's so rare that I get a chance to actually sit down and talk with Jessica, and I have such high regard for what she and her team does. I'm just gonna hijack this.
No,
Sorry,
feel
Matt.
free. Just bring me back in when you're ready. So can you, Matthew, you at CAPROCK, you created this thing called IPAR, which is a proprietary measurement system of impact, which you've now spun off. Can you just give us a bit of the background to what that is, why you created it, and why you've now spun it off as a separate company?
Yeah, we approach the process of assessing and reporting very similarly to what Jessica does. So that's why I was curious when I misunderstood your comment about reporting. But what launched IPAR was a request from a client for a consolidated impact performance report. And our default strategy for that was to collate all of the reports from the managers with whom they had capital. And we ended up with a 268-page report, which basically rendered what was otherwise really interesting, innovative, rigorous impact reporting into a horizontal mess that was not usable and got filed in the circular file really, really quickly. And so we decided we needed to engage in a process of what we call dimensional reduction, which is, in our way of thinking, applying a true taxonomy to the notion of impact reporting. And I think what I think I just heard Jessica say was that that was not a path that you guys chose to take, but it is a path that we chose to take. It ended up triggering an enormous amount of interest among the asset managers that we work with. Several of them asked us to license the tool so they could use our report in their marketing material, which was a little bit of a light bulb moment for us. And so we spun the IP off into a standalone impact-facing fintech company at the end of December.
So for you, what was the measurement challenge that you were solving?
Yeah, the pain point for us was to create a consolidated impact performance report. If you think about the analog in the financial world, one could deliver a performance report to a wealth holder who had a diversified portfolio with multiple managers, maybe some private investments, et cetera, and just simply give a stack of performance numbers and not roll it all up into a composite performance. And I think that in the financial world, that would not be acceptable. In the impact world, that's totally acceptable. And so we are trying to engineer on the impact side the same kind of reporting that we do on the financial side. So we have a consolidated financial performance report and consolidated impact performance report. And yes, anytime you move towards consolidated performance reports, you lose granularity. But we believe that is an inevitable consequence of doing a consolidated performance report. And then eventually, we hope, holy grail moment, to merge those two data sets.
So are you getting, I guess you get a financial return of 7% a year. Are you getting an impact return of X%? Is it that consolidated, or?
Yes, it's a much longer conversation, and I would encourage you to go to the website, iparimpact.com, so I don't steal this entire panel talking about IPAR. But yes, effectively, yes.
And Jessica, do you feel they're a very different approach that they're taking to what you're doing?
Obviously I've looked at IPAR, and when we were establishing our own kind of methodology behind this, we looked at a ton of different resources, and obviously have a great amount of respect for IPAR. It's even just like a great technology. It's a great tool, and we're not there yet having something that you can find an impact risk assessment in a couple clicks. But that's the kind of stuff that we are doing. So I know that we had like a little different way that we would do it, but their impact risk was an important component to what CAPROCK is measuring. And so there's some definitely overlapping degrees to which we're doing very similar things.
Now, Dan, you are a long-only public equity investor and have had a long interest in socially responsible investing. You ran a BlackRock fund that was doing that, and you're on the board of SASB and so forth. A lot of people say the public equity markets are a hard place to actually be an impact investor, because essentially you're bound to have a relatively small percentage of any company you're invested in, and it's a secondary market anyway. You know, how much influence are you really going to have? Does the term have meaning for you in the public markets, and how do we measure the impact that you might have?
Yeah, so you touched on a few things, that it explodes all sorts of areas of interest. So let me go at a few points. You know, picking up on a comment earlier in one of the earlier sessions, you know, all investing has impact. It's a measure of, is it intentional, and do you measure it? Do you hold is there an accountability mechanism, whether it's to the asset owner who maybe the investment manager is trying to deliver an impact? So some of this discussion is really on the measurement issue, but just stepping back more broadly, I would absolutely make a very strong assertion. All investing has impact. So public equity, like if you want to make an impact, you want to go where you can scale. Or if one wants to scale, you know, one would go to, you know, whatever the Willie Sutton thing is. You don't hold up the gas station, you go to the bank. Well, you know, trillions of dollars of market cap, you can make an impact at scale in public equities. I would take that view. To the point, though, of are you going to, you know, advocate and agitate and drive impact that way? That would be one approach to life. That's not my approach as an investor. My approach as an investor echoes kind of some of the comments earlier in the discussions, which is to take a long-term business owner view, which I think is why venture capital and private equity frankly works, is that those are long time horizon, taking ownership attitude. But where the impact aspect comes in is thinking about externalities and thinking about, again, comments that were made earlier, talking about, you know, employee retention in a high growth private company, where those same issues exist in public companies. The highest value business models, irrespective of whether they're listed on a stock exchange or they're a public unicorn or they're a private unicorn or a private small company, doesn't much matter if it's big or small. If it's a human capital business that has extra normal returns, a great business, a franchise that has return on equity and financial characteristics that make for a great business, intangibles matter. That typically comes from human capital. So to cut to something specific, you know, that's an example. Impact matters. A measurement around human capital retention can be one way to get at that. And so that would be sort of one way to, if you had to rebut the idea that, oh, you can't make a big impact or there's not a role for impact investing in public equities.
And do you feel like that's something that you know, you ultimately want to be able to report back to investors, or is this something that's more useful for your own internal allocation decisions?
So both of the above. Let me echo on some of the comments Matthew and Jessica were you know, talking about how measuring on impact in the private space, and again, drawing out Matthew's analogy to consolidated reporting versus just a dump of documents. There's a lot of the latter, a dump of documents. There's an explosion of metrics. There's information overload. If you go to a Bloomberg terminal today, there's about 980 sustainability KPIs that you can pull down on the screen. And to get to SASB, the idea of the Sustainable Accounting Standards Board is one of a number of initiatives trying to improve the signal-to-noise ratio effectively. And so all this data, there's an explosion of issuance of data in the past decade or so, decade and a half. There's a huge opportunity now for investors, for asset owners, for fiduciaries to glean information, both as in making investment decisions and also as an asset owner to take stock of impact. But you have to be, I think, you could, you know, curate the data is one word I would put against it. You have to be thoughtful about the data. And I would just pull the analogy to traditional financial investment due diligence. Impact is not some sort of separate silo. In my mind, it's integral, where it's most meaningful, and sustainability is most meaningful when it's operationally and strategically relevant to the business. And so to the idea of a consolidated report, how to effectively convey and deal with measurement, think about traditional financial measurement due diligence. You don't sit down with a client and explain line by line why you own, you own this 28.3 multiple PE stock. Explain that. Oh, but this stock is at 0.4 times book value. Explain that. That's not typically how a due diligence discussion would go or how a client communication of a portfolio. And yet that actually happens in sustainability and impact. Like they'll gear in on, oh, this third party entity gave a score of X and it's in the tail, so explain it. And if that can be helpful to convey something meaningful, great, go for it. But that I think it's very dangerous with the idea that that would be the be-all, end-all. And so there's a bit of dynamic right now where we are in this space, I think, of give a person a hammer and every problem looks like a nail. So there's an explosion of data, and I think there's a huge opportunity to be more thoughtful in using the data. And so in the private space, I think public and private markets can evolve best practices. An earlier comment made, 20 years ago, you didn't even have a diversity statistic of females in a role or whatnot. And today, that's one of the metrics you can pull down on a Bloomberg terminal.
But there's a very basic question, for the first three speakers, and I'll then come to Erica. But it seems to me, in an ideal world, you would want to be able to take two companies, similar industries, and be able to say, this one has had more positive impact and more sustainability than that one. And you'd also want to be able to take two investment managers that claim to be investing for social impact and be able to say, this one is a better performer in delivering social impact than the other one. Are we anywhere close to being able to do that in a way that most people would agree with
I don't think we're close to doing it without pretty thoughtful work, but the beauty is the conversation's starting at least. So it's started.
And Jessica, Matthew, you'd share that?
Totally.
Yeah. So it's still a ways off.
There's a huge role for the intermediary, I think, to add value, and that was a point earlier in the panel. The intermediary has been a roadblock to mass adoption, but there's a huge opportunity for value-added intermediaries to help curate and explain, and then in time there'll be transparency. And Vanguard was around as a direct entity, decades ago, and it just went vertical in the last couple dozen quarters in terms of really inflecting. And so maybe there can be an acceleration. Some of the folks talking today about transparency, but there's a huge opportunity of a value-add role for intermediaries, I think, here.
Now, Erica, you are one of those intermediaries. What's your perception on this measurement challenge, and how important is it that we get to a stage where we can answer those two questions those comparators that I mentioned?
Well, what I worry about, the measurement challenge is dramatic, and there's kind of three things that I really worry about. I worry that sometimes you have a situation where there's false precision attributed to measurements. I think that's dangerous. Sometimes you're in a situation.
So what would be an example of that?
Well, when you think that you can completely capture the social impact of whatever, a mining company operating in a particular place that is not only challenged in terms of the community, but challenged in terms of resources, water, anything else. I think it's really hard to capture kind of the secondary and tertiary impact of these companies that are doing right and those that are doing not so right. So I think that's, again, the false precision or the pursuit of precision when you can't have it, I think is really damaging, and it could be a roadblock. So I think we just have to be really honest about what we're looking for and what we're doing. So I think that's one dangerous thing that I worry about. Another thing that I worry about is there are times when you put a measurement or a metric in place, and those around you or those who are managing to that metric are actually doing it really well, but frankly, you're not getting the economic outcome that you want. In fact, you might be getting the opposite of what you want. So the behavior associated with the measure or metric really needs to be considered. Again, you don't want to undermine the economics, the big picture, the value that you want to create. Actually, I'm reminded of a quote from Albert Einstein. Everybody knows that quote, what you can measure is not always, that's not what matters necessarily. There's another quote. Einstein said that we should aspire not to be a success, but to be of value, all right? So when I think about that, I really think about what metrics do we have and how do you avoid causing damage, genuinely damage. And then the third thing I worry about as it relates to, I'm a Jewish mother, I worry. But the third thing I worry about is the extent to which looking for the precision, and now I'm talking in private markets and smaller companies versus public, but I worry about a potential burden that the search for precise and multiple outcomes and outputs can damage what we're trying to do. I mean, face it, a little entrepreneur might simply not have the systems to measure what a giant foundation is asking of them. So are we actually, causing a problem in terms of capital flows? So those are some of the things that I worry about as it relates to measurement. And then when it comes to the public markets, I actually think that these conversations about measuring impact are going on at the board level of the largest companies in the world, and they haven't figured it out yet. But it's a really important conversation. And so when we think about Coca-Cola and using air to clean their bottles, or we think about Dow Chemical and making the energy usage at hundreds of plants more efficient and bringing emissions down, or when we think about an Intuit with QuickBooks and making the ability to take a picture, of an income form from someone who's not in the banking system, and they can file it that way, and then they get a tax refund, and then they put it into the economy, all right, which is something they have to because it's not discretionary income, and all good. That's all good. So again, this is a lot of complicated stuff, but I think about this on behalf of our clients. And by the way, I think that anecdotes really matter to clients, the clients that we work with. And I think with the anecdotes, you can start to get to the specifics.
So, I mean, as you're looking at this as a research firm, how confident are you now that you're able to identify meaningful impact opportunities that you think are robustly supported by data, or is it still more in the anecdotal?
No, I think it's doable. Again, I just think you have to avoid those three pitfalls that I talked about. So we diligence hundreds and hundreds of funds and look for the ones that align with our clients. And I would argue that clients that are willing to take a concessionary return are probably more likely to want the specific measurements. Clients that are going for market-based returns are more happy with those anecdotes.
Now, you also stepped out from a big Wall Street firm to do this on your own. I mean, to what extent do you feel, you're significantly different in the research you're doing from where the rest of the market is? And obviously there's been a lot of movement in the big firms as well, we're hearing. I mean, how much do you think they've changed?
I think they've changed very little, frankly. I think they're starting. Happily, I didn't really do it on my own. I had a wonderful, committed, mission-driven, or I have a wonderful mission-driven staff. But I think what's maybe different, Cornerstone has been referred to as kind of a piece of infrastructure because we do have a different business model. And by the way, some of the biggest consultancies in the world, the BCG, as an example, would tell you that to truly have impact at scale, you need to have an evolution of a business model. You need to see business model change. All right, now I don't know that we've seen that. In fact, I don't think we have in the largest firms. When I think about our firm, what we've done is fused kind of sell-side institutional thematic research with kind of buy-side manager due diligence research. So when we diligence a manager, we are looking for what we refer to as deep integration. All right, so when you really understand the way the manager is thinking, that's what's so critical. When I think about Dan and Jarislowsky Fraser, I mean, again, looking at governance, the G in ESG, as first among equals. If you get the governance right, then you have to be looking at the environmental and social imperatives. So, we would argue that someone like Dan does this deep integration. And I think it was Nancy Fund who mentioned how sometimes new firms, or even old firms, you can build a culture and new firms from the start that is about deep integration into the business model.
I'm going to go to the floor in a minute, but I wanted to come back to you, Dan. SASB, I think, is very interesting because of the approach it's taken to move away from the idea that there's going to be just one measure of sustainability that will be across all industries at all, all activities and all times, and come up with a single unit. And instead say, industry by industry, let's create common standards for that particular industry. Talk a bit about why you think that was a good idea, and what you're seeing, and how soon that's going to really be rolled out properly, and what impact you hope it will have.
Sure. Well, I think the way it's maybe important to spend a second to talk about how SASB got to this point, where now they have something called a materiality map, which is, SASB is a nonprofit. This is all driven as a public good to drive the idea that don't take the attitude of you got to hammer every problem looks like a nail or whatever. There's all this data, this explosion of data, but to make some sense of it was SASB's initial challenge. And Erica with me was one of the founding board members, and this was an idea on the back of an envelope in 2011. David Blood, who spoke earlier, is one of the earlier supporters through the Generation Foundation. So there's all this data and this interest in, like, why don't we do something about it? SASB took a scientific, empirical, arm's length sort of attitude, throw it all against the wall, not with a data mining attitude, but with I think a fundamental attitude of what's relevant to the business, and ultimately came to a view, the data supported, take an industry-specific view. So one of the frameworks developed at SASB is the 6 framework, the Sustainable Industry Classifications, which the idea that what are of those 980 KPIs in the Bloomberg terminal, or like hundreds of different KPIs by different research providers, you put your head in the oven, put your feet in the freezer, or vice versa. On average, you're at a good temperature, right? Those metrics, when you roll them out at a single score, that's kind of like your body temperature. It masks the information. And so SASB, one of the innovations over years of digging through, ultimately was this industry classification framework. The government security industry classification codes literally still have a buggy whip industry code. So, I mean, there's talk about, one of the risks to not integrating ESG and thinking thoughtfully about the long term is that you could have stranded assets. Well, stranded assets is not just petrocarbons in the ground. Remember the Razor flip phone? That's a stranded asset. It became irrelevant and dead. The Nokia candy bar firm, which in the year 2001, I had colleagues who referred to Nokia as like a Nestle. It was it was a consumer brand that was durable and forever. It's like those became stranded assets. So the issues by industry are very different. And so SASB has brought that framework forward from a framework to much more specific, at this point, standards that are being codified with input from industry groups, from management teams and investors alike, to type frame, like if it's a human capital business, human capital metrics are going to be part of the management dashboard for management. And to the extent that the management is willing to open the kimono, create transparency to their stakeholders, to their investors, and their employee base, that can drive a positive dynamic. But that's not going to be as relevant for a machine-intensive basic materials business, which is maybe more asset-intensive. In that case, maybe safety issues, environmental input, et cetera, become the most important.
How close are we to having all the industry is sorted out as to what they...
Well, very close in terms of the work SASB has done in terms of providing a framework with consultation from in the thousands of investors and issuers alike. And so now the next step is to get adoption. So there's the Winston Churchill quote about, we're at the end of the beginning. And maybe someone else can articulate the full quote. But I think that's where we are in sustainability measurement. We're in early innings, but there's a bunch of work that's done. It's quite exciting. But it's taking the raw information and again, going to improving the signal to noise ratio. There's a huge opportunity to provide nuance to that. And again, it's a huge opportunity for intermediaries. It's a huge opportunity as investors. Increasingly, the surveys I mentioned, they want to align, whether it's a strict mission-driven at a foundation or just in a more broad sense, have some degree of ideals alignment. That theme is literally hundreds of years old. But now that you got the tools to report and do it in a more credible, thoughtful way, but there's heavy lifting to do it.
Lester Solomon from Johns Hopkins University and author of a recent book called New Frontiers of Philanthropy. I wanted to ask the impact panel how they deal with the difference between the measurement of the impact of service activities and the impact of advocacy activities. In this country, the civil rights movement was probably the most impactful force we've had in the last 50 years. It didn't create schools, it didn't build housing, it didn't clear communities of environmental problems, but it had an enormous impact. And the concern I have is that the pressure to go to impact measurement will shift all of the funding or much of the funding towards services and diminish the funding of advocacy.
It can actually work directly against you. To your point, I had lunch a year or so ago with a guy who was responsible for Rockefeller's granting into South Africa to end apartheid. And he said that if they had been tracking metrics for 40 years, all the metrics would have gone the wrong way. The regime got increasingly violent. Black people in South Africa were increasingly marginalized economically, even from an opportunity perspective, and yet they knew it was the right thing to do, so they continued to grant into that country to end apartheid. That's a great case example. And yet, I think it depends upon what the theme is, right? Because you've got some investable themes are quite output related, and others are quite outcome related. And outcomes, the advocacy work, might take a generation or more to appear. And so to measure that could be not just complicated, it could be nonsensical, at least in yeah, I am. I think it's something, and I think that Erica flagged through similar concerns around materiality and around the reporting burden and the expectations. And I think what Dan pointed to, which we would agree with completely, and which is what's sort of a shout out for what's
So if you took a company like
Unilever,
which is where the CEO has very publicly got involved in things like palm oil initiatives and things, I mean, it would be quite hard to measure that impact, would it? Or would you even bother trying to?
Well, you can measure the replacement factor, right? How many liters of palm oil are not being used from non-sustainable palm plantations. I mean, that's a very easy metric to measure. And so if we're using that as a proxy for a shift in the supply chain of an essential lubricant, then that's a very useful outcome, right? But
in terms of the years of lobbying and things that he spent before he got to that point.
I actually, at one point Erica made that I was sitting over here nodding about was that anecdotes are actually quite important.
Yeah.
So we get really obsessed with finding metrics, but what about, I will say, for example, when we're looking at public companies and kind of the way that we're reporting out to clients, we're including shareholder advocacy as a key component of that. Now, what SASB is doing is very important in terms of materiality of actually how companies are investing, but how they're actually engaging as shareholders is something, when you look at, your very first question to me was, what do our clients care about? Actually, the anecdotes really matter to our clients. So when they're picking a public equity fund, it's hard to do apples to apples, but they might choose a fund just based on the fact that they have a better track record of shareholder advocacy, and that might be important to them. So,
anecdotes are a terrible basis for allocating capital, aren't they?
Well, I mean, it's just if you're
because there's no auditing. You pick the nice pictures, and so they made prior. I mean, no one would invest in SASB for the anecdote.
Capital, which is a forward-looking activity, and reporting the anecdotes, which is a historical process, right? And it's important to decouple those when you're thinking about portfolio construction.
By the way, the only thing I would add to this particular issue is you got to remember, complex problems can't be solved sequentially, right? You have to have multiple parallel initiatives going on, all right? So we can do all of it. We can do all of it at the same time, and we have to. And I know with us, I mean, one of the ways that we analyze our fund managers is we really want to know if they're engaging, if they're really engaging. And to the extent that you need to look at sustainability issues on a temporal basis, because it's not always the same thing that's a critical issue at the same time. So you need to look at the temporal issues, and then you need to look at the ability to engage. We have a framework, it's called the Shareholder Alignment Frontier, and it's an aspiration, it's a corporate aspiration. Can you get the shareholders that you deserve, or that you want, and can you get in a better alignment so the kind of behaviors we want to see are encouraged? And I think you can. You just have to kind of raise the level of consciousness and this ability to deeply integrate issues, advocate, engage. But it can be both. It has to be both.
Matthew, I'd love to comment on your anecdote. That's a terrible way to invest. But maybe I can work another Churchill quote. It's like, except for all the other ways I've tried, democracy is the worst except for everything else, right? Well, so I would never advocate investing on anecdotes, full stop. However, investing on false measurements is like a sure recipe to disaster. And we've seen that happen. If you have metric, if you try to solve for a metric, to be nerdy, investing on price to book without regard to balance sheets was, brought us to the financial crisis and quant meltdowns and hundreds of billions of capital going away that won't come back. But I want to embrace this idea of like taking a long-term vision. Culture matters. So I think that's how I respond to this idea of advocacy. It's like, well, culture matters. What are you trying to solve for as an asset owner? You wanting to align an attitude of taking the high road. It's taking the long road. And if it's a 5+ year time horizon, which is remarkably unusual amongst institutional investors and retail investors are alike, and there's no difference. They both have the same 12-month plus or minus time horizon. To take that long view, if you're going to use metrics, they need to be 5+ year long metrics. And so many of the metrics have this, like, they're great, but they're stale in 5 months or a year and a half. And if you've got a 5-10 year horizon, I think you need to have an investment process that embraces the idea that leadership, culture, these things matter deeply. And if you want to have measurement tools to help you get at those things, you need to calibrate them, use them in that kind of way.
Hi, I'm Zachary Carabell from InvestNet. There's a move, as all of you know, in sort of financial advisory world of personal benchmarking or goals-based investing as a way of saying, look, it's not about whether your ego beats the S&P 500 every year. It's are you investing commensurate with what your return and lifestyle needs are? Have you thought about using that as a way to incorporate more impact portfolios into not, this is going to be exactly the return of a non-impact profile investing, but rather part of the mix of a investment portfolio that serves the end needs of a particular client, literally, not just morally, but also financially?
Matthew?
Yes. The beauty of goals-based investing, or whatever terminology you want to use, it liberates you from the tyranny of the S&P 500. We do not have a single family, and I think foundations, endowments are really different. We don't have a single family whose life cycle and needs reflects the performance of 500 capitalization-weighted companies traded on the American Stock Exchange. It's just that's not what it is. And so as soon as you can decouple the return expectations around market performance versus a lifetime discounted cash flow model, which will drive an individual family's return objectives, et cetera, then you can start reverse engineering a portfolio that pursues impact across all asset classes while solving for that key variable of target rate of return. And so yes, it is a totally different conversation, which can be both really disorienting for people who are used to that conversation and really liberating for people who don't want to be harnessed to it anymore.
Vivina Berla from Saron Asset Management. I wonder if you could comment about the Sustainable Development Goals and how they, and their 169 targets, and how they might shift the conversation about measuring impact.
All right, I can't resist if we're talking about Churchill, okay? So,
how about if you find yourself in hell, keep walking?
Keep walking.
Can you use that quote?
So, Churchill said, it was right after the war, and he's standing in front of a decimated parliament, and he said that we build our buildings, and thereafter they build us. So if you think about that, we're talking about framework. We're talking about, putting in place a system that supports what we're trying to do, And now this is really embarrassing because I actually forgot the question.
So I'm trying
to dig up the
sustainable development.
It's a beautiful quote.
Are the sustainable development goals, I guess, are they a building we want to be in?
That's where I was going. The SDGs actually are a great framework. And the cool part about them as a framework is that unlike the MDGs before them, they engage corporations, they engage the private sector, which the MDGs did not. And so, this is what's so important. If we're going to move the quantum of capital, right, trillions, to get to where we need to be, you absolutely have to have the private sector. You have to have the corporations that are really thoughtful, really progressive, that you need them to be raising the bar for everybody else. And if you look at the SDGs, we're not going to hit them all. They're fabulous. We should go after all of them. We suggest that companies kind of pick the ones with which they're most aligned. But the fact that there is a framework for moving things forward, framework matters, So I think it's different this time. I think it's critically important. And I think I owe you a drink because I forgot the question earlier on.
But are you seeing much, interest from clients around trying to think through how the SDGs would be a
for us,
framework?
frankly, I have stay on the pulse of what everybody here is putting out in research, and so I've read plenty about SDGs. I'm not hearing about it a ton yet from clients, but they're new. I don't think that means it's not coming, but it hasn't really been, I haven't gotten a call saying we're going to rejigger our investment policy around SDGs quite yet, frankly.
I would just add a quick thought. I think they're good insofar as they provide a framework about, hey, and it's sort of incontroversial. In my opinion, it's sort of in the mom and apple pie. This is good stuff. But you'd be dangerous. It can be dangerous to let, again, to get over bias to a measurement or a specific point target or whatever. But the idea of measurement drives accountability, transparency, and it's a good thing broadly, but I think you just be careful about how you apply it and reserve some judgment and art, I think, in the investment process that takes a long-term view. But I wanted to mention that, for me, a big light bulb moment the conversion moment, people talk about their conversion moment in ESG as an investor. For me, it was, for years I looked at the Fortune 100 best companies to work for list, and at some point I realized, well, this is just a KPI for human capital, and now there's lots of acronyms, and that was probably before people used the ESG language. So within the SDGs, likewise, there's going to be good metrics and around some of these, what are you trying to solve for? Keep that a part of the process, but also I think reserve judgment. There has to be a role for that in any kind of really long term.
Can I just add, the conversion, one of my conversion moments was a conversation with you that you probably don't even remember. But I went in and we were talking and you asked me, Erica, what's a proxy for quality? And then we started talking about ESG integration. Thank you for that.
Mm-hmm. So we're pretty much out of time, unfortunately, but I wanted to end by asking each of you, given the overall theme of the day is around how do we mainstream this approach to investing more rapidly, what aspect of the measurement challenge would be your number one priority that we have to solve in order to get this, to accelerate the mainstreaming process? We'll start with you, Dan.
I think just the attitude that metrics drive accountability, but it should be management should have the microphone. The onus should be on corporate managements to use measurements to help rally their troops and convey what's strategic and meaningful to their business.
Jessica?
The term that we throw around that comes to mind just about the measurement challenge is not letting perfect be the enemy of good. And so, we're starting where the market is, where we are, what our clients are asking for. And then on mainstreaming it, I'd say one of our very important roles, collectively up here is to push managers to be better, because they're the ones that are really, truly collecting and measuring data. And can I make one other just very quick point, is that unless you want to tweet at our recruiters, I'm at Jess Matthews CA. That's my Twitter handle. Those are our recruiters. Unless I said something terrible and then tweet at the recruiters.
And if you said something really interesting, attribute it to me. I'm just going to echo what Jessica just said. That was perfect.
Okay, and Erica, last word to you.
I would like to see in the boardrooms of the world the debate between macro indicators and kind of more micro efforts to measure their impact. That debate has to happen for us to have impact at scale.
Let's just illustrate that a bit more.
Well, let's say you have a chemical company, and they are going to decide, we're going to measure the revenue impact of all of our products that touch sustainability, macro indicator. Or we're going to have a measurement that looks at the number of suppliers, because these chemical companies have thousands of suppliers, the number of suppliers that we fire because they haven't been meeting our audit goals, right? That's a minor, it's a small but really important metric to understand what the company values, what they care about. This is a big macro indicator that's going to be tougher. So I just want to see the debate.